The United States struck Iran's Karg Island early Tuesday, the hub that moves 20% of the world's oil, and within hours crude jumped to $116 a barrel. That is not just a number. Oil has now risen 70% in 26 trading days since the Iran conflict began, the fastest sustained energy shock in recorded history, worse than the 1973 embargo, the 1990 Gulf War, and the 2022 Russian invasion of Ukraine combined, according to the IEA chief. Russia and China vetoed the UN resolution aimed at reopening the Strait of Hormuz. Trump posted that, "A whole civilization will die tonight if a deal is not reached by 8 p.m. Eastern Time." Markets read that as a threat to civilian infrastructure, power grids, bridges, which under international law would constitute war crimes, and which economists say could trigger a global recession on its own. The economic transmission is already running. The New York Fed's April 7 survey showed one-year inflation expectations at 3%, up 0.4 points, with gas price expectations hitting their highest level since March 2022. Gasoline is now averaging $4.12 a gallon nationally, up 80 cents from a month ago. WTI hit $104 on March 30 and has not looked back. The Federal Reserve is watching all of this with no clean exit. Fed funds rate sits at 4%, unchanged for 4 months. Chicago Fed President Goolsbee called the situation a stagflationary shock that puts the Fed in a bind. His colleague at the Cleveland Fed, Beth Hammack, said she could see a case for raising rates if inflation stays sticky. The Atlanta Fed GDP Now model now estimates Q1 GDP at just 1% annualized, down from 4% just 2 quarters ago. 1% growth, 3% inflation expectations, 4% unemployment. The three variables of stagflation are assembling simultaneously. The Fed cannot cut without feeding the inflation. It cannot hike without crushing what little growth remains. That same geopolitical fear that sent oil higher and growth expectations lower produced a split inside technology that is easy to miss in the headline numbers. Apple fell nearly 5%, not because of the war, but because of a Nikkei Asia report that the foldable iPhone has hit engineering setbacks. Bloomberg later disputed the story, but the damage held. A $40 billion intraday swing on a single sourcing conflict. ARM Holdings dropped more than 4% after Morgan Stanley downgraded it, citing near-term R&D cost pressure and memory shortages that could slow its strategic pivot to AI chips. Microsoft fell on reports that Iran had weaponized its infrastructure to conduct cyber attacks on Israeli systems, a new category of war cost that markets had not priced before this week. But on the same day that those names fell, Broadcom gained 4%. The reason is structural, not accidental. Broadcom announced a 5-year expansion of its deal to build Google's Tensor processing units, a collaboration that began in 2016 and now includes supply of networking and rack components through 2031. In a separate agreement, Broadcom and Google committed to giving Anthropic 3.5 gigawatts of TPU-based compute, starting in 2027. Anthropic CFO called it, "our most significant compute commitment to date." The company separately disclosed a $30 billion annual revenue run rate, higher than OpenAI's last disclosed figure of $25 billion. The bifurcation is not random. Consumer-facing hardware, phones, consumer devices, is exposed to a demand shock as inflation eats discretionary spending. Infrastructure chips, by contrast, are being locked into long-term contracts, precisely because hyperscalers need to guarantee compute capacity before the next AI model cycle. Nvidia is down 20% from its record high, but trades at a lower forward PE than the S&P 500 for the first time in 13 years. Arista Networks was upgraded to buy on the strength of Google and Anthropic data center orders. The war is compressing valuations across the board, but the infrastructure layer of AI is finding buyers at these prices. Beneath the oil shock and the chip divergence sits a structural problem that the war is now making visible. The U.S. national debt stands at $39 trillion. Trump's FY 2027 budget assumes 3% annual GDP growth for a decade to bend that trajectory downward. The Penn-Wharton budget model ran the math. Even accepting the White House's growth number, faster growth drives up borrowing costs, and at $39 trillion in outstanding debt, a modest rate rise adds $750 billion in interest costs that offset more than half the projected revenue gains. The war in Iran adds another variable. Penn-Wharton previously estimated the conflict could cost as much as $21 billion more in federal outlays, a figure that grows with each Karg Island strike sortie. The IMF chief warned Tuesday that the world is ill-equipped to handle the combined shock of energy disruption and slowing growth. A Harvard economist cited in Business Insider called the incoming wave of inflationary pressure painful, and said interest rates could stay elevated far longer than markets expect. The S&P 500 trades at a forward PE of 20 times. That multiple does not tolerate higher for longer rates well. And with a Fed that cannot cut, the compression in equity valuations is not a temporary fear trade, but a structural repricing. The weight of evidence points toward a prolonged stagflationary pressure period, rather than a clean resolution. That judgment holds only if Iran does not reopen the Strait of Hormuz in the coming days. If a ceasefire materializes before the end of this week, which Qatar and several Gulf states are actively pushing for, the oil spike partially reverses, inflation expectations cool, and the Fed regains optionality to cut in the second half of the year. That recovery path is real, and the market would price it fast. Two things to watch: whether WTI holds above $110 after Trump's 8 p.m. deadline passes, and whether the April consumer sentiment print due Friday reflects expectations anchoring higher or starting to pull back. If oil is still above $110 by Thursday, and sentiment deteriorates further, the stagflation thesis gains another data point. If WTI drops back below $100 on any ceasefire signal, the entire macro thesis shifts, and the tech names that sold off on macro fear, not earnings, become the fastest recovery candidates.